The canonical example for me, AJ, of people self-serving data and being mathematically correct. You're in the room and you're like, I have a different number than your number, is CAC payback period. Why is CAC payback period an important metric for you to track at Datadog?
It brings together your top line momentum and results, as well as your investments and the expenses. I think it's very easy to look at an investment decision and say, well, this is adding incremental revenue or it's growing quickly, so it's successful. But then you're leaving off the picture of like, what investments did it take to get there? And vice versa. You might say this is cheap to do and it's quick and easy, but okay, but is that adding any incremental value? So this is one of the few metrics that actually brings those together. And I think in comparison to things like, LTV to CAC, that I found is less valuable. One, because the inputs are so sensitive, especially for a high retention, high gross margin business like us, you can get results that are just a little bit silly and also sort of hypothetical in that sort of multiplier framework. The payback approach is very tangible. It's like, if I make this investment today, I'm going to recoup my cost in a year or a year and a half or whatever it is. It's also pretty comparable across companies. So you can go to public comps and if you have your non-GAAP sales and marketing expense, your non-GAAP gross margin, and your revenue, you can get an apples to apples comparison of how efficiency compares across external stakeholders and get a good sense of how you sort of stack up against public peers. And then it's also a rare metric because you can use it not just at that like high level company metric. You can really click down into the organization. And of course, you have to make some assumptions of how costs are allocated and things like that. You can understand, for us, we look at our sales channel payback to understand how our different go-to-market engines are working and how the efficiency there compares. And you can keep going deeper and deeper where you go by region, ultimately by country, and you can look through that lens for any investment decision you're making on a comparable basis.
I love what you said about LTV to CAC actually being like almost too compound of a metric and too sensitive of a metric. I often find it interesting and telling in the long term, but actually kind of worthless in the short term.
We're trying to make decisions based off of the data. If I get something that's very hypothetical and super sensitive to inputs, it doesn't add that much value and frankly doesn't give you much confidence moving forward with a decision.
You mentioned using benchmarks for CAC payback period, but you also mentioned using the number internally to make decisions. Do you think CAC payback has a different value if you're talking about it operationally just within your Datadog team versus externally, and either benchmarking yourself or talking to investors?
The publicly reported metric, it's always going to be very high level and it's going to be an amalgamation of a lot of things that happen. And, it fluctuates, and every business has a different business model. So it might be less or more applicable depending on like the accounting of your revenue, of how much services revenue you have, what the gross margin means. So sure, there's a little bit of comparability stuff in there, but it's just a helpful guidepost of, are we best in class? Are we middle of the pack? Are we bottom decile? So you just get a little bit of the red, yellow, green there. To me, the more interesting part is the one making operational decisions off of. We might want to make an investment and throw some money at something, but we always want to start with a hypothesis of what is the actual payoff going to look like? Well, like, in a year, if we do this thing, what do we think this is going to look like? What is the incremental revenue that's going to come from it? And when do we expect to recoup that payoff? And does that degrade or improve our efficiencies as a company? And that may, be a good thing or a bad thing, but we want to be very conscious with what we're moving forward with.
Well, let's talk about that. You mentioned drilling down from global sales channels all the way down to country level CAC payback. Can you think of a time where that type of analysis led to a meaningful business decision?
Datadog at its essence has kind of two core sales channels. We have one that's focused on enterprises, so larger companies. And then we have one that's more of inside sales, which is more of a velocity motion, selling to more of your cloud natives and smaller organizations. They have a motion where they land the initial customer and then they hand it off to our customer success team. One of the things that we had done initially is even just take a step back to understand between those two motions, what is the relative payback? And even, from being at the organization for many, many years ago, as we become more enterprisey, there was a little bit of this question of, are those efficiencies going to degrade over time because an enterprise sales motion is heavier and more difficult to actually deploy? What we found is that they're relatively close to each other just because the mix of what we're spending to get that customer dollar is different. For instance, you might have more of your digital marketing spend and your advertising dollars going toward that cloud native and that more velocity motion, but you're going to have a, heavier sales focus with larger, OTE type of AEs focused on the enterprise. But net, they look and feel relatively similar when you sort of blend it all together. That's a good starting point and from the benchmarking. And then some of the things that we've piloted or we've looked at are things like, account coverage and ratios for every AE. How many accounts do they own and over what period of time? Because we have a blend of different, AE groups that are a little bit more hunter, a little bit more, curator and gardener. will we be better off if we have our best reps holding accounts for longer? And what does that actually payback look like? Been able to move forward with some pilots for, certain groups of AEs holding onto accounts longer because it potentially is more expensive, right? There's more commissions, dollars, and time and attention that's going to go to those accounts. But the thesis is it'll pay off in longer term healthy customer relationship and potential more use of the Datadog platform. So that's where that benchmark of what good CAC payback looks like started us off on that journey of what this pilot might actually uncover. And we've been able to move forward with confidence and continue those over time and measure the success of them.
Sometimes you just gotta give the guy the rock and let him cook. That was truly beautiful. We have a view of your finance team, how the FP&A team partners. I think both of us have been in positions before where we're looked at, rightly or wrongly, as kind of the no department, the people who put the brakes on things. How have you been an advocate for growth, and how have you positioned your team to say yes to the right things?
I see when parts of the business are newer to working with finance, they oftentimes have an allergic reaction and they're like, oh God, finance is in the room, like clutch your pennies and because we're going to be looking for all of them. It takes trust and relationship building and asking good questions to sort of shake that off. But I think at the end of the day, especially at a growth oriented company like Datadog and a lot of growth tech companies, I don't see us as the no people at all. I see us as the yes, but people where we want to spend money and we want to invest, but we just want to understand where that money is going, what the thesis on the payback is going to look like, what we think we're getting for that money, and being able to measure it and actually tell what's working versus what's not. And if we gain confidence that something is actually working really well, oftentimes we're the first people sitting at the table saying, well, why don't we double down on this thing? And it might come from some reallocation and saying, okay, well, this thing over here isn't working as well. We should inspect that and understand that further. I think you see the shift change often through those planning cycles where, folks think that we're going to come just by sort of pulling back the envelope as much as we can. But we're actually trying to connect the dots and saying, hey, you have a really interesting idea over there. Make sure you're talking to that person. Make sure you're all working on the same things. And by the way, we think this thing is a huge opportunity. Why don't we go further there and double down and really invest heavily here?
I think the willingness and just showing a couple of times publicly that you're doubling down on something goes a long way. It just shifts their frame of mind. Like every time I come into this room where finance is there, it's not necessarily that they're going to cut it down. They may look at this like this is a portfolio of bets and they actually are encouraging me to go bigger.
And I think there's always like a burden of proof, which is also what I tell my stakeholders. Like, whenever they come and they say, well, can I do this thing? And I'm like, well, maybe, like, tell me the why. Like, help me understand what you're trying to achieve and why you think this is going to pay off. And we can work on it together, right? That's the partnership aspect. You're not alone in it. Like, let's unpack it. Let's work through it together. And then ultimately, maybe we can actually pull the trigger on something.
Here's a growth tax that nobody talks about. Every new pricing model you ship creates a nightmare for your finance team. Usage-based pricing, now you're tracking usage against commitments. Product bundles, now you're untangling what to recognize and when for every line item. Mid-cycle upgrades, good luck manually reallocating revenue. The pricing strategies that drive growth are the same ones that break your finance process. Right Rev turns that irony into a competitive advantage. Your product team can ship new pricing without asking finance for permission, and your sales team can close deals without worrying about downstream chaos. But I've seen too many companies where sales are celebrating a huge quarter while finance is still trying to figure out how to recognize half of it. It's actually me. So here's a good place to start. Right Rev built a free tool at calculator.rightrev.com. It scores your RevRec process, shows what's exposing you to risk, and tells you exactly where to focus before it bites you in the rear. Probably explains why your last close took so long. Check it out at calculator.rightrev.com. All right, without the Boston accent, calculator.rightrev.com.